Thank you very much. It's a pleasure to be here, and for change, coming from the World Bank where every other person is an economist, it's actually very attractive to be in a different audience and not only to talk about sort of the economic way of looking at the world, but then maybe that's also something I could add to the debate, sort of bring a bit more the economic perspective. And in many ways it has been surprising that the word prices hasn't really mentioned so many times. I think this will be the first thing people mention in the World Bank. Now I want to take a little step back since the last session, if you wish, and sort of say, when I started out with the topic, the resilience or the risks in the global agricultural system, I was that's sort of one particular area of the whole debate. And sort of taking one step back, one could think about agriculture, which sort of has three problems, or addresses, as a sector, it addresses three different challenges. On the one hand, the challenge for the sector is to provide sufficient food and labor, to provide sufficient and cheap food, which could then release labor to do other things. And that's sort of, in agriculture economics, one could think about as the food problem. At the same time, it's a sector people working in it, so it should provide a decent living for its farmers. So let's call that the farm problem. And then finally, and a lot of people in this room particularly would be probably more focused on that, is it should do so in a responsible way, in a sustainable way. So it should preserve the fields and their environment, since it is very much a user of the natural resource base. So let's call that the field problem. And I would argue that basically the relative importance one attaches to these three objectives changes as development takes place. And basically, in developing countries, I work in the Africa region, just getting food on the table is still a relatively major concern, if not the only concern. So the food, just getting food, is sort of the key challenge. Whether that's done in an equitable way or not, that's sort of a second challenge. And then, if some of the environment gets screwed, if you want to use some bad words, then so be it. You know, that could be one way, that's sort of a way in early stages of development. If you want to prioritize, I think that would capture that. So in a way, the emphasis also lies on efficiency. So if you think about economic efficiency, that's sort of associated with that. Now, as countries develop, what we call here the transforming societies, think China, then basically this food problem, they have gone through that first phase. They're no longer at the 1 of the 1, 3, 6, 10. They're at the 3. Actually, China is already at the 6. So the income inequality, which was just referred to, becomes a bigger issue. And I'll explain a bit of that. Because basically, as agriculture, as societies develop, this non-agricultural sector starts to grow. You look at GDP growth, agriculture never gives you high GDP growth, but the other sectors, 8, 9, 10, 12, 15%, that's where the action seems to lie. And as a result, you sort of get an inequality arising because 70% of the people are still in that agriculture sector. They earn a lot of their living there. And some smaller group, they're exiting, they're leaving, and basically they start to get a lot of the benefits. You see an income gap arising, and then a lot of good or bad things happen. And basically, so the income inequality becomes an issue, sort of political sustainability issue. And I'll talk a little bit to that in the Chinese context. And then as countries develop even further, and maybe we could talk China now, where you see that, look, in the 80s, it was about food on the table. In the 2000s, it was about reducing that income inequality. But now the environmental issues are coming much bigger to the fore. And sort of, you may have noticed the colors, the yellow for the cereals, the red for the socialism, the equality, and the green for the fields. So the field is becoming more important. Now, if I may hazard to add a fourth set of groups to that, what is it in sort of the urbanized societies, if you wish? What do we care about? Food, there's plenty of it. It's abundant. It's about quality. It's about standards. We talk about post-harvest loss. We want to go to the shop at 6:30. We want to be sure we have everything there sitting for us to buy. So that creates waste because it needs to be there. Some of it will be perishable, and people or the supermarkets may have to throw it away. We want our apple to look the same across all the apples on which we buy. We don't want the deformed apple. We want a nice apple. If it's deformed, we throw it away. If it's a little change to it, we don't like it. So basically, it's about quality, it's about standards, it's also about experience. Being in Belgium today, every day there is a cooking program. Food is an experience. You go to the restaurant, it's sort of almost like agriculture becomes like an experience. So that may, I'm stretching it a bit, sort of different values being added. Now, the food problem. Just want to walk through two items, the food problem and then the farm problem, and link it back to this idea of risk. What are sort of core risks in the global system, the global food system? I think currently our global food system, or agricultural system, is based on sort of market-mediated food security. The idea is simple, based on core economic principles, that the world production, market-mediated food security, is that food production should happen in the countries which have a comparative advantage in doing it. That's where it can happen most efficiently. Then you trade. And actually in trading, you could also reduce some of the risks. If there's open trading system, if harvests fail in your country, they may actually be abundant in another country. And so if you use the whole world to diversify, you're not diversifying within your country, use the whole world to diversify. That's the principle. If that works, then you could also help diversify your risk. And the prices, the global prices, they basically are supposed to steer, to signal scarcity and thus introduce investment. If prices go up, you start to invest. If prices go down, that's a sign of there should be enough. This is sort of the broad principle we look at. And then we do some regulations and rules at the market. Now, I would just, and this has come up already a couple of times, so there's two systemic risks in this broad system which I would like to highlight. One is a coordination failure, and the other one is that the system may not be very good at actually signaling the need for investment. This has been referred to, so I'll be relatively short, but this is the evolution of the world rice price in the late 2007, 2008. And basically what you have here is in the early 2000s, or from the 70s onward, food prices were on a downward trend. Early 2000s, they started to go up a little bit. It was sort of a slight upward trend, but it was barely movable. So basically, at that point, 2007, wheat production, world global wheat supply, got a hit. India got a bit, and also was also a big hit in the wheat production in India. And India got a bit scared, because they were afraid that they had to import more wheat at a much higher world price already. Wheat prices had gone up. It was a crossover to rice, some substitution between the two. So they basically said, look, let's put an export ban on rice. Let's keep the rice in our country, and this way we can help keep the rice prices down so we don't have to deal with the population which is not very happy with high rice prices. So we can kind of keep the pressure, political pressure down. So they introduced an export. Now, India at the time was a major rice exporter. Very rapidly, Vietnam followed suit. Vietnam is another major rice export. There are only very few, five major rice exporters in the world. They also introduced a ban. Now, there are also only a couple major rice importers, Philippines and Indonesia being two of them. The Philippines gets very nervous. The Philippines basically, once the prices are rising, there's not enough rice in the market, they think, and they're going to buy rice at any price. They don't want to have political pressure. So basically the prices shoot up. They put in a second tender and the prices peak. This all happened while in effect, there was sufficient rice in the market. There was no rice production shock at the time. So we're kind of arguing here that the reaction, like if this is an information failure, coordination failure, the fact that countries are signaling, look, I'm an export, but I'm not going to give it to you because I need it for my own population. That then for the importers puts pressure on them. I need to be re-elected next year. I better put rice on people's table. Otherwise, I'm not going to be re-elected. So I'm going to do anything to get the rice. That's the Philippines. And this interaction between the two basically made prices shoot up. Now, a lot of that could have been prevented if basically there was an information failure here, but it's also a coordination failure. The second thing I wanted so this is sort of the idea that coordination failures in that market system lead to this high price volatility. The second point on world food prices. Basically, the whole idea that investment happens in response to food prices. For years, basically, if you look at what happened in the 70s, there was a rise, there was a world food crisis, there was a high world food prices, and basically governments started to invest a lot. We talk post-harvest loss. Actually, you go to the literature, late 70s, what do they talk about? Post-harvest loss. Why didn't they talk about it in the 90s? Post-harvest loss wasn't lower than it was in the 70s because the prices were high. People were scrambling, having the same debates as we are having now. So basically you saw there was a lot of investment, prices came down, and then for a long time, everybody in this room who works in agriculture knows that in the late 90s, 2000, nobody wanted to invest in agriculture. Not the donors, not the public sector. Okay. So nobody really wanted to invest. So the prices were not a sufficient signal for basically investment in agriculture. As a result, yields growth went down. And since it takes time for the system to produce results, as soon as demand continued to rise, you got the diversification in diets, which was just talked about. And as a result, you basically get this collapse, this coincidence, a shock to a system, some coordination fails, which is exacerbated in the response, and food prices peaked again. That then induces certain responses. But the whole idea, which at the point I really want to convey here, is that we have a market-mediated system, a food security system sort of as the core basic principles, but there are a number of market failures in it, which basically bring us that we have a system where having food price spikes every 30 years, if you go through the last 100 years, that's about what you observe, is sort of built in the system. And this is something we are willing to live with. So the idea that, look, risk and efficiency have to be traded off, and how much is the price we want to pay in order to get less food price spikes, but that may come at the cost of some efficiency. That may be something we could debate. Thank you.
Today we're going to switch it up a little bit and talk about issues of rural credit. And I want to preface this with this graph over here, where the top portion is looking at the cumulative rainfall. This is in Marsabit region in Kenya. And this graph down here is looking at the frequency of the long rains and the short rains. So in sub-Saharan Africa, everything is dependent upon these two factors, long rain and short rains. When we talk about credit markets in developing agriculture, or even in developed agriculture, the failure of credit markets to emerge, we call that a systemic failure, not so much a systemic risk. For us and Dan's, in our little world, we call this systemic risk on this, where we have these large covariate risks on that. And this we see all over the place. India, Sub-Saharan Africa, South America, China, and even early 20th century America and early 19th century Europe on this, where there is failures in the credit system, largely because of the risks that farmers face. So whether or not these are coming from the drought situations, or whether or not these are coming, which affects quantity, or whether or not these are coming from market situations which affect price, commercial lenders were not eager to lend to farmers. The United States and Canada, the Germans, the Europeans, all came up with financial structures, the Farm Credit System or the Farm Credit Corporation, in which to deal with agricultural lending. Developing countries have avoided these, even up to this moment in time. So, what's the story telling us, right? In terms of the risks that these pastoralists might face in the desert regions in Marsabit. When we look at, let's say, this period here, 1997, that's good because most of the regions got both the long rains and the short rains. And when we were in Kenya last year talking to farmers about what we'll talk about here, risk-contingent credit, here's where the story comes. When both rains come, everything is fine. When the short rains fail, things are okay, but we can get by. When the long rains fail, that's really rough on us, and when both the long and the short rains fail, we hit famine conditions. These three events on that determine pretty much the livelihood of what's going on with the pastoral farmers, and of course many of the other farmers in Kenya. And here we can sort of see the patterns of this. You see 1991, we had a few sites which had short rainfalls, no sites with long rainfalls. 1992, we had about 25% of the sites that had long rains and no sites with short rains, and on it goes. These systemic risks which come over time and time again in a repeated fashion, but in a random way to do this. These kinds of risks make lending to agriculture almost impossible by any commercial lender on that. One of the things that we saw even in the development of the Washington Consensus, right? The idea of libertarian views towards restrictions on banking and so on, the idea was that we don't have to worry about agriculture because so much money is going to be generated that there are going to be spillover events. This did not happen, right? Essentially what happened was so much money was consumed in the urban sector that lenders would ask, well, why on earth would we go and lend to a small, expensive, highly risk producer when we can lend to a lawyer in town who's very safe on that? And this you see everywhere. Central America, India, Africa, China, right? Where there is a systemic failure in the market, even with the free market system at its best. And the reason for that, of course, is because there was no infrastructure in place. There was no credit system in rural Africa. I know Equity Bank is trying to make its way in there, right? In China, when the Agricultural Bank of China had a very big placement all over, but then when they loosened the restrictions on that, then what happened is all of a sudden all those offices closed, right? The rural credit cooperatives in China, which emerged in the 1920s and the 1930s through cooperation, they're now coming to rural credit banks, and what are they doing is they're moving outside of agriculture. As a matter of fact, in China, an agricultural loan is not a loan to farmers, it is a loan to an agricultural region, right? They're not making loans to farmers on that, but it looks really good, right? Making lots and lots of loans to agricultural regions, so agricultural loans are on the rise, but loans to farmers who are producing food are not on the rise. And the reason is something like this, the nature of systemic risks, right? Why would they deal with that? Because when these events happen, such as in 1999, the drought, and again there's a drought in 2011, which takes about 3 or 4 years even for those pastoralists to get out of that situation, to evolve out of that situation. So, here's what happened in Kenya. When these things fail, even on the milk side, milk producers, on the pastoralist side, right, we're going to get these huge seasonal shocks related to whether or not the rains come and go. There are many risk strategies, risk coping strategies that are limited. One of these, I think we'll talk about, is index-based livestock insurance. Can absorb some of those asset risks on that, but in an imperfect way to do that. And the problem is the balancing of the business risks and the financial risks. And that's the business risk of the lender as well as the borrower, right? The key requirement is there a guarantee? Is there some form of collateral, right? And there are many banks which will not look upon livestock which could die in a drought as being good collateral, when in fact the main risk that these guys are going to face is the loss of those animals in a drought situation, right? So animals are not going to be a good collateral on that. Nor are the farmers themselves, when they look at that livestock as being their livelihood, willing to give up that animal as a piece of collateral on that and the productive assets. So we have non-price credit rationing on the quantity side for the lenders, and also risk rationing by the borrowers themselves, saying, I'm not willing to give up my livelihood, and so they're sustained and not taking advantage of leverage in that system. We have been talking about about this idea of risk-contingent credit, the idea of linking insurance into a credit instrument in order to balance that. And if you look at this graph over here, here's some event. This is an NDVI payment scheme, where as the NDVI falls, that is the browning of the land in a drought situation, that's assumed to be highly correlated or have covariant risks with some bad stuff. And so then that goes and pays off the loan. And over there you can see the red line is what the loan would normally be, but the insurance part compensates the loan in that situation. Here's multiple milk structures on seasonality, don't worry about that. But here's what one might look like for short rains. We have a loan amount, and if all goes well, short rains and long rains come 100% of the loans. If the short rains fall, maybe 75% of the loan is repaid. If long range fails, then maybe 60%, and if both fail, then maybe only 25% of the loan is repaid. And these are embedded into the loan contract. Farmers will pay a higher interest rate for that, but when those events happening, the farmer is protected and the lender is paid at the same time, trying to manage both the collateral risk and the balance of payments itself. And my time is up, so I shall stop there with my 7 slides as instructed.
I'll be talking about many of the same things using a different way of talking about it. For many farmers, climate change means more bad years. That means, just based on simple math, adaptation to climate change means you have to be producing more in the remaining years you got left. So the challenge is that a lot of the strategies, a lot of the things like taking out a loan for fertilizer, that can double or triple or sextuple, see if I get I'll stop at that level. Those kinds of things, you really have these opportunities. But the opportunities for, say, 4 years out of 5 to have your farm be many times more profitable, much higher yields, if you have that one drought year, say out of 5, that's threatening, if that year happens, you could lose everything. You can't repay your loan, or the bank faces massive defaults. You may lose the farm, you may lose your animals. And so because of that threat, you can't take the chance that you need to be the farmer that you should be, and the farmer that you need to be in order to adapt. So the key to adaptation for many of these farmers is to reduce the risk of the threat from that bad year so that you can take the chances to unlock the productivity options. So I've been working a lot on index insurance, which Cal pointed to me at as he was talking about this, as one of the possible tools where there's been hope. It's pretty new, and it's a strategy to help offer farmers in developing countries access to insurance, or banks in developing countries. And the idea is that instead of using a traditional insurance kind of product where you have to go and check and see if the crops die before you get the payout, you give a payout based on something that could kill the crops. Like, let's say there's no rainfall at a key time of the year. And so if you have one farmer on 1,000 acres, you can go check and see if the crops died. And you can also check and see if the farmer's working to let the crops die in order to get the payouts. But if you have 1,000 or 2,000 farmers on those pieces of land, you just can't make that work. And so the idea is trying to find strategies, things you can measure that allow payouts that target that 1 year out of 5, so that farmers can take strategies, or banks can take strategies to increase productivity. And that pays for the insurance, and then everything works out wonderfully. Everything is awesome. The problem is, of course, that this is a huge challenge. You know, it's very easy to get this wrong. And, you know, this is not like insurance. This is not something you buy and suddenly you're safe. This is something where you're buying, and it sometimes helps you, but not always. And we're communicating between NASA and some of the, you know, smallest farms in the world, places where people don't necessarily even know how to write numbers. And if we get it wrong, then people think they're safe, they take a chance, and then there's a big problem. And so there's been a lot of floundering insurance projects around the world too. So what we work on a lot, and I think what some of the key things are, is figuring out ways to help the farmers understand what the products are and be able to help design their own products, integrate them into their decision systems, whether it's the crops that they choose, the loans they take out, the borrowing they do from their family, because, you know, I can't tell them that, and I don't even know. I don't even have the data. And then work in a very systematic way with satellite data that as the satellites try and measure the droughts, and we don't know if they work, to try and connect with what years were droughts and why. Do the satellites agree with what the farmers say? If not, what do we do? Who's right, who's wrong? And then there's a range of research topics related to these, ranging from the physical sciences of remote sensing, rainfall, agricultural systems, to the behavioral sciences of what choices do farmers make? Are they making good choices? How would we know if they're making good choices? Are we the naive ones? And so there's a lot of these economics and social sciences issues that we're looking at. And there are some projects that do have impacts and do well. And some of these projects, probably most of the projects don't really do much. Some of the projects go from a couple hundred to tens or hundreds of thousands of people in a couple years, with some of them showing real impacts in terms of wealth that farmers have afterwards, women changing from sharecroppers to working their own land. But how do this question is, how do you connect some of these intergalactic partners to the smallholder farmers to try and get more projects to show anything or to be lasting, to identify something that's worthwhile? And I'll finish there.
Okay, so I'm a biologist following 3 economists, so let's see what happens here. Okay, so I'm going to talk about the environment and risks associated with agriculture. And many of us are aware of, this is just showing nitrogen inputs, nitrogen outputs, and that's what's remained in the environment for problems. Most of us hear about the too much nitrogen, too much phosphorus, too much pesticides. We're all familiar with that side of environmental degradation with agriculture. Not as many people are aware that when you don't put things on, you also degrade the environment. And it needs a lot more attention. So it's a case, again, of Africa. I'm showing Western Kenya, where farmers are mining the soil of its natural capital. And they've reached a point where yields are very, very low, and there's often not much they can do to get out of that. So this is just showing ecosystem functions as against agricultural intensification. Agriculture starts using natural capital, the nutrients in the soils, the nutrients in the vegetation, and people use it, they eat, they can get better income, and at some point they reach a level where they can't get any more out of it, so they start investing. And you start increasing again your productivity, some of your ecosystem services. The contention is this is where much of sub-Saharan Africa is here right now. You'll see this solid line down here. This is a case where there's no land tenure. People will not invest. There's no incentive to invest. And in many cases, that's where people get stuck. The real challenge is how to make this thing move up. And there's not a lot of evidence yet that this can work even at small scales, let alone large scales. So I bring this up because everyone keeps pointing to Africa. That's a place where we can really increase food production. There's a huge yield gap. There's a real opportunity to produce a lot more food on land that's already been cleared so you don't have to deforest. So is that the case? So I'm going to talk about soils at that point. There's all sorts of other things that are degraded at the bottom of that: biodiversity, carbon stocks, all sorts of things. But there's loss of topsoil fertility due to erosion. There's loss of nutrients and soil organic matter that provides all sorts of other ecosystem services. And then there's physical problems, compaction, crusting, and things like that. The physical problems are much more difficult than the chemical ones, but I'm going to talk about the chemical ones just so you get an idea. Here's just some examples of soil degradation. That's a slope in Uganda just after the crops were planted, and there was a huge rainfall event. wiping out many of the seeds. Nutrient depletion, surface sealing, and then compaction. They couldn't even take a soil sample. It was so hard. So everybody says, okay, so let's just rehabilitate those degraded lands, get ecosystem services back, get higher yields. The point is it comes at a cost, and people just often don't consider those costs. So to rehabilitate degraded agricultural land requires increased labor without any question, and usually increased capital inputs, whether it's fertilizer, all sorts of other inputs, nutrients in many forms, organic or mineral, and carbon. Carbon drives many of these systems. It drives the energy, it drives the microbes, it drives nutrient recycling and many ecosystem services. And I'm also just going to say biodiversity, unfortunately Shahid is not here, but that's what you need. All of these are costs to the farmer, poor farmers with few resources. Just a quick, this was an intensive effort of extension by many, many scientists, including Pedro, including me, many people, in some communities, and every farmer was talked to. 10 years later, 5 years later, a study was done. Okay, so who really adopted these efforts to rehabilitate these degraded lands? You'll see 20%, that's not bad, but this was intensive efforts. It went up and then it went down. Why did it go down? Because people were doing these not for food production, it was for income because they were able to sell seeds from the trees. Once that market for the seeds from those trees went away, they didn't do those things that would help their fertility, help food production. Those that did adopt it did it on less than 10% of their land. Again, it's a small scale. Other reasons were labor requirements or the land requirements to produce a fallow vegetation or things like that. They have to forfeit seasons many times to produce biomass, to produce the nutrients, and then land tenure issues. Just another example for Zambia, looking at different types of farmers from very poor to well off, actually still being quite poor, in their ability to use fertilizers, manures, and different kinds of improved fallows and things like that. There are lots of constraints to these. Adoption is in fact low where there is adoption, and it's on very small pieces of land. So just to summarize, in these areas where we think there's these huge yield gaps, there's lots of technologies. They're out there, and there are things we can do. But there's also more and more information now that even when you use some of these technologies, there's not a very large increase in yields. They're called non-responsive soils. We're not sure why they're there. You can put fertilizer on them, you can even put manures on them in many cases, and you're not getting that response that we think you should have, and we're trying to figure that out. The other one is access to these technologies. How do people get that information? In an area where there's broken extension services, there can be one extension officer for 100,000 people in some of these places. How communication technologies help, but these are the facts. If you're going to really increase food production, these are the risks that they won't get the information. The other one is the whole thing about finances and just credit. It's just not in rural areas, and people do need inputs. They need credit. And then just there's a risk of not having the adoption of these technologies. And so there is great potential, but let's be aware of the risks, starting with the financial risks. But in addition to that, there are biophysical limitations, there are demographic issues, and all sorts of other constraints to this potential adoption. Thank you.
I don't have slides. I decided to listen to a wonderful set of talks and figure out how I might contribute. I'm an immigrant here from the energy and climate world, and I've been struck more than once before when I venture into the world of agriculture and food, forestry, and so forth, that so many analogies work. But in addition, that there are some very important impacts on the biosphere from the climate problem that can't be wished away. So my remarks are in two parts. The first, I will talk about the direct impacts that relate to the climate problem, and then I'll talk about analogies. Several times today, people said, well, biofuels are just too much demand on the land. We can't afford them, and this is what they did with their hand. It was visible hand. The invisible hand was not mentioned, but it's going to be very hard to keep solutions to climate change from impacting the biosphere. And to believe that you don't have that to worry about would be a big mistake. Try to say, how do I quantify this? $100 a ton of CO2 is the kind of price that would, for emissions, that would begin to have a chance to affect the investment patterns away from fossil energy. The kinds of numbers that have been in European markets, maybe $25 a ton today. The Europeans are trying to put back a price in the European trading system in that range. $100 is where you'd have to be, and people know that. $100 translates a ton of carbon dioxide, turns into $400 a ton of carbon, which turns into $200 per ton of biomass. So there's a number. I want to really make some connection here. $200 a ton of biomass. We're looking at prices of rice. I was pleased to see that, in which it was a significant amount, but within the range of excursions. Think of that price in each of your domains and say how dislocating would it be. It's enormously dislocating for the competition between coal and natural gas, for example. Really favors natural gas over coal and would shut down coal plants and develop natural gas. What does it do to forests and crops? And then really think it through. I'm pretty sure it's a perturbation that is big enough to be on your plates. How much more land will be? As soon as you have a price like that, the fact that the biocarbon has been made by carbon from the air with solar energy means it's in principle non-carbon fuel. You have fertilizer inputs, you have tractors, you have all the other things, which change the picture. You may have cut down a forest to plant something. That's what Tim Sersinger called attention to, the indirect emissions. But after you take all those into account, there will be many, many situations where what you're trying to put on somebody's table can also go into a gas tank or can also light a light bulb. In fact, one way to think about this is that there are 4 strategies for using biocarbon to deal with a climate problem. The first is a stock issue. Just put more carbon in plants on the planet, in the soils, in thicker trees and forests, in more intensive grassland use and so forth. All of those are ways of taking carbon out of the atmosphere, and they'll be paid for. The second is to turn biomass into fuel. It has a second purpose, which is to affect oil markets, but it also has a climate problem, and climate solution because it displaces oil, transportation fuel. Third is to make power, just either on its own, throw some crop waste or something into a boiler, or co-firing, as it's called. Add it to a coal plant and lower the emission score, perhaps getting it within to the newly proposed EPA rules, which are all about carbon per kilowatt, and it's going to count fossil carbon. And the fourth is another form of scrubbing of the atmosphere of carbon dioxide, like increasing stocks, which is, for example, to make power from a biological crop, capture the carbon dioxide in the exhaust and put it below ground. That is a scrubbing of the atmosphere strategy as well, and it's got a name. It's called BECCS, Biological Energy with Carbon Capture and Storage. If you look at the IPCC report that just got from Working Group 3, BECCS is the workhorse of achieving low carbon targets. It usually occurs in the second half of the century. All of these are in the hundreds of millions of hectares to make a difference. And they're supplemental to each other. Okay, so you have an enormous impact coming down the road. Technical issues, lots of people like residues, crop residues and forest residues, on the grounds that you're not apparently interfering with the production of food, apparently interfering with the production of forest products or biodiversity. This problem of to what extent can residues be removed from land without consequences for the productivity of that land has been hanging out there is the problem that I think most needs work, because there is so much interest in those residues on the part of the climate crowd. For goodness sake, you're the guys who can figure out what that's about. What do you need to return? And these are crop waste from corn and rice, and as well as forest products. But for you guys, the corn and the rice and so forth are really big deals. Pasture, and one more and I'll move to analogy. One more is the pasture land, and nobody mentioning feedlots. So what is the trade-off if the very nice pictures of forests and improved forestry, improved pasture management, in turn goes one more step to American-style feedlots? Is that, in fact, a climate-attractive project? Because now all that other land is available to grow something to put in gas tanks. Are you thinking that one through? Is there anything that will be attractive about that from a pure economic package? And my message from that is, this is about conditionality. If you have to put yourself in the minds of someone who has been tasked with having the maximum possible impact on climate for a given number of hectares of forest or agriculture. What will they do when there's no constraint of any kind other than to improve the effect on climate? And then figure out that they'll monocrop, they'll add lots of fertilizer, they'll do things with water and so on. And some of those will be things you don't want them to do. And then put yourself in the minds of a policymaker and say, what do I have to add in the way of conditionality so those bad things don't happen? So to my mind, this whole intersection is about conditionality. If conditionality is thought through ahead of time, we may be able to navigate all of that. Analogies are all over the place, and I'm running out of time, but I saw pick out the single most interesting one that came up over and over again, which is it is rich and poor. It is really productive to think about the energy and climate problem stratifying by income, and it is here too, but to be very explicit, problems of poverty almost have no relationship to problems of wealth and prosperity. In the case of energy, colleagues of mine and I wrote a paper called 1 Billion High Emitters. Those are the people, it's not so different for 13610. 10 tons of carbon dioxide emissions per capita per year defines the emission level for individuals above which about 1 billion people function. Almost all Americans, about a quarter of about 20% of the Chinese, half of the Europeans, a lot of other people, about 1 billion people. They contribute, I don't know, 2/3, something like that, of the total emissions. There's another 3 billion people below 1 ton of carbon dioxide per person per year, who are the abject poor, the target of the Millennium Development Goals. There are all kinds of perverse strategies. The World Bank is suffering under the instructions that they must not use fossil energy to deal with the poorest people of the world. And rather than bring in a diesel engine, a bus, a modern cooking fuel. But if you work out the numbers, 3 billion people taken not from poverty to wealth, but from poverty, abject poverty, to the lowest level that isn't abject poverty, where the girls do go to school and there is immunization. You multiply that with just, let's say, 1 ton of CO2 per year by 3 billion people, you've got 3 billion additional tons in a system that's emitting 35. So you've got a 10% effect of dealing with abject poverty to the level of low middle class, or whatever you want to call it. It's just off the bottom, and it's what the Millennium Development Goals are all about. That does transfer over here. Poverty and hunger and all the solutions we're used to it are not related to eutrophication and dead zones. They're not related to obesity. They're not related to the price of corn in global markets, except very indirectly. Many of the things you're talking about are problems of prosperity that get worse as we get wealthy, because the planet is bounded. And another set are about poverty. It's really productive to make that distinction. The UN makes it difficult because they talk about per capita numbers, which bury the prosperity of the wealthy in the poor countries. So you have to break that barrier down, but you really will make progress if you make that distinction. Okay, now I'm going to turn back into moderator.
Just a brief comment and a question. So I actually don't completely agree with your bioenergy analysis in that the reason bioenergy appears to be attractive carbon option is only to ignore terrestrial carbon. In every situation, imagine a piece of land doing one thing or another, you will always have a larger carbon savings, at least for decades, so time, letting that land for some other purpose. So I think it is the case, so this is a longer, I think it's all based on an accounting error that believes that just because biomass stored with plant growth, that makes it carbon-free. And that's the accounting error, and it wasn't actually, it's not even in the IPCC International or National Accounting Guidelines. It doesn't work that way.
Obviously, okay, so you have to do the accounting right, and Tim has been pointing out accounting errors all over the place, largely, and he's right. But even after you take those into account, there are many places where you would manage a forest to increase its yield, and it's standing carbon and those.
There are lots and lots of you will always, in virtually every situation, have an increase in carbon for decades. So you have to wait a really long time to get a greenhouse gas reduction. So it only matters.
Well, this is, of course, a technical point that Tim has been trying to resolve. He hasn't carried the day with, and it seems to me unlikely that every single application where biocarbon is supposed to be a climate solution isn't valid. But if you're right, then that's just not on the, eventually we'll do the accounting right, presumably pretty quickly.
Well, I can give you a very simple explanation of why that is, very, very quickly, which is that the amount of carbon that you save whenever you harvest some terrestrial carbon, the amount of carbon you save in fossil carbon is at best half and often less. And so the amount of carbon you keep from the atmosphere is greater leaving the carbon standing. And yes, there's true that you get flows of carbon in, but those flows of carbon are used in one way or the other. They're used for food, they're used for timber, or they're used to restore carbon. So that's a longer discussion, but I do think that it is the case that you can get competition for food up to maybe 25%.
So the way to gloss that is, Tim is going to chip away at the case for biocarbon in the first place, hopefully with every bit of success that his accounting deserves. And in meanwhile, there will be bad accounting that will push, as well as appropriate accounting that will push against the uses of the land for the purposes we've been discussing here.
Anyway, my question is on the crop insurance, front. So in the U.S., no farmers bought crop insurance unless it was subsidized. And once it's subsidized, it's not really insurance. It's just a subsidy that you give to a farmer through an insurance company, or the other way around. So do you have examples of where you're actually getting this to work without a subsidy, without essentially having the government pay for quote the insurance?
Yeah. Hello? Oh, it's on. It's on. Yeah, so I think there are examples. Some of the examples that I presented there were of unsubsidized products, and we really try and fight against subsidies in insurance products because they are just a way of masking subsidies, and they end up not really covering risk. In the U.S., there is also a market in between. It's only been in the past couple of years, a market in between the subsidized government insurance and I guess the derivatives market, where farmers are purchasing unsubsidized index insurance. It's a narrow market, and the whole engine that drives it is you have to find something where the insurance actually allows you to make more money. And you know, in the Ethiopia project, it's an unsubsidized product, but farmers can buy it by working, and that takes donor money to do that. Although, having said that, in that project, thousands and thousands of farmers just coming with cash saying, I also want to buy this. So I think the key is, and this maybe abridges things, maybe I'm just tired, is it's not looking at the averages always, but saying, what are concrete problems that we might be able to solve with certain things if we work hard and think through them, and how do we break that into a manageable list, and how do we have, you know, isolated smallholder farmers who are the decision makers working with large international reinsurance companies to solve problems. And I think that's the problem that's facing us today, is these complicated problems that are if you address them correctly, you're getting something that has some, oh, it's obvious that intuitively we all see that this is the way to go and these are the things we have to worry about. How do we transform piece by piece these big global decisions into those kinds of things?
Okay, let's come at a few questions. First, 1, 2, 3, 4, 5. Okay, take them so I can remember that.
Mine is a comment also related to the insurance, but also the governance that Dan has just indicated. There is another project that I'm involved in of index insurance, which actually bundles it with credit availability for farmers. And this is bringing in actually private banks who have never done this to smallholder farmers. And the fact that they have the index as an objective measure gave them the benefit of going into it, while at the same time the bank, the insurance would be giving and farmers were ready to pay and they are paying it, and it's in its third year and some very interesting results are coming out of that. But it is a fact that it brought in resources and finance to the farming community that they never had before. So in its own right, they may not have gotten into it, but the fact that it brought credit actually brought both the lenders as well as the borrowers. So we're also trying that aspect, which is giving an. But now to Dan is you have touched a very interesting point, and one of the big problems that we're finding is, of course, there is reinsurance, and that is where the international governance and others are coming, and that is becoming a real barrier for most of the smaller insurance companies in developing countries, where even when they are taking most of the risk, whatever risk is also left for the international reinsurance companies is not forthcoming or not as easy as it should have been. So what kind of governance, and we were talking today actually about the governance, would actually induce the international reinsurance companies? And this is one of the discussions that was coming.
That's part of that question, so we get a couple of others. 2? Yep. Identify yourself, even though you may have spoken before.
Yeah, Eric Chavez from Imperial College, and I work in weather insurance as well at World Bank. The one of the current technical questions on weather insurance is that, well, one uses historical data to calculate a premium based on the historical risk. But as it becoming more and more evident, the statistics of weather and the statistics of extremes is changing in time. Due to global warming, taking that into account, how do you see technically weather index insurance taking that technical challenge forward? And do you think, and might be a question for yourself, could the mechanism of weather index insurance, which has shown is very promising, can it be linked to other risk management instruments such as early warning or, I don't know, to respond to these challenges?
The questions to insurance. Was your question on insurance? Okay. Was yours in there?
It's related in that my question also goes to banking and the ability for people to save money when they have those 4 years that work well. I understand in many places there aren't good mechanisms to actually save the money. So is it an insurance question or is it a banking issue sometimes, and access to credit and capital?
Good. And gentlemen in the same room, was yours an insurance question too?
No.
No. Okay, so let's have the 3 insurance questions discussed by the panelists.
Is this on? Okay. Oh, you just hear me?
It is on.
On the issue of the index insurance, one of the biggest problems is this thing called basis risk, right? I mean, we've done a lot of this stuff, And when we first started working with index insurance, it was all very nice. Here's the location. We just assumed everything happened at that location. As these things started being investigated by more and more people, we sort of saw these problems come about when we're using the historical data at a given location on that. And what happens is it may not be so much in terms of climate change that you're seeing these ever-shifting things. A lot of times it might be due to the strength of the data. Let me give you an example. In the United States, there's a very nice data set, very clean, 30 years. But it excludes 1934. Right? It excludes 1934, 1932, 1936. The worst drought years in American history are excluded from that data alone. So there is this problem of the data itself and what's used to calculate these things. You have to be really careful of that, and also the correlated risk. These products you can also scale, depending on how you're measuring it. So if the prediction is that this is going to be a hotter than average year, then you can sort of make a scale adjustment within a given year in order to adjust the premium for what the climate forecast might be for that year. On the credit side, the issue of savings is a big thing. There's this whole idea of financial inclusion and whose inclusion, and that includes breadth as well as depth. So breadth is how many people actually get access to credit or financial services, including those, including savings as well as borrowing. There's a thing called redlining. That's where a bank may set up in a rural area, accept all the savings, but never lend in that area. Just transfer that savings out elsewhere, right? And so you don't get a lot of depth because not a lot of people actually use the services available on that as well. So financial inclusion, and inclusion, I guess, is the other term for that. There's also a pretty important area which hasn't really been touched upon in this area, but expanding the role of financial services in these rural areas. And you just don't see it in these developing countries. Right? You see some inroads here and there, but they're just not getting that. Financial education is also a pretty big deal when you're talking about it, largely illiterate population in many areas as well. And I'm glad to see that you're doing some stuff on risk-contingent credit. This is fantastic. The balancing of business and financial risk is a key problem. And you can actually get micro-insurance, micro-lending, balancing these two things, and it ought to work. So I'll keep track of what you guys are doing.
Does another one of the panelists want to comment on this? 3 questions.
I would want to link with the presentation by Cheryl. Fertilizer profitability. We sort of start from the assumption that that's going to be profitable to do. One of the reasons why people may not adopt it is because it just doesn't fit. The cost of the fertilizer combined with the output increase for the product, it just may not add up. You know, they're actually rational and they're a profit maximizer, and it turns out they've done their math right. And this may well be determined by a number of settings, like bad soils or unresponsive soils, where fertilizer just doesn't pay at the current cost. So actually I just read a study looking at the profitability of fertilizer in Nigeria, where that's exactly what they are showing, that in many instances, actually it's not profitable just doing the costing. Now, once you subsidize it, it does, of course, become profitable. But then, in a way, you set yourself up for failure unless you basically, there are other reasons. The input providers are not in place, and by kind of creating a market, there are going to be input providers, so that was the reason. But if it's really not agronomically profitable, subsidizing it may be a problem. Now I link it back to insurance. So you could think about another reasons why people are not adopting fertilizer, maybe because of the risk. They have to pay up front, they don't know if it's going to rain. If it doesn't rain, they have cost, and then they have to pay back, and maybe they lose their assets, and those they prefer not to adopt. So in order to help them do the risk management, one could think about subsidizing the risk management. That could be either through linking the credit with the banking. The idea of that individual farmers are going to buy a lot of insurance, just the transaction cost of doing that in the setting is quite complicated. Maybe bring in the financial sector with other sort of with banks. That may be a better way. So the whole idea is how to get the adoption up, and what kind of instruments you use. If it's subsidized, then it's not profitable. That may set you up for problems. If it's a risk thing, then basically by subsidizing the risk, you may well help the situation and not have the point that people are doing things which are not profitable to begin with.
Just to underscore, I think these points are really, I'd like to support these points. I think the key with the insurance is that it typically is not successful when it's used alone. And you need to be connecting it with banking, you need to be connecting it with different types of agricultural practices, you need to be connecting it with savings, you need to be building these things together, and you need to have a governance system because the insurance won't be a strong enough tool, it won't be addressing climate change issues, and there'll be a lot of basis risk left untouched that you need to use other things to cover for. And it's when this package makes sense together, and you find some governance to build this package with all these giant programs and complicated programs, that's when you start seeing the reinsurance companies cooperating more. That's when they have some comfort that something makes sense and you're actually solving a problem as opposed to just following what's on a bunch of PowerPoints at, global capitals.
Okay, let's try some questions not about insurance, starting with Victor.
Okay. I have 2 points actually related to your presentation, Rob. One is on this idea, how much crop residues can we take out to make ethanol? It's a very dangerous thing. There's a lot of research.
Is the question dangerous or the answer dangerous? Is the question dangerous or the answer
No,
dangerous?
the question is good.
Ethanol's dangerous.
And the answer is not dangerous. Is the question, how much residues can you take out? There's been some research in the Midwest. It's actually very little you can take out. And people think that residues are trash. The Chinese, in previous years, took out all the litter layer of forests in many areas to fertilize rice fields. And bingo, the forest died. because that was part of the nutrient cycling system. I don't think they do that anymore. But to consider residues as sort of trash, useless stuff is wrong. Agronomically wrong. The second point I wanted to make is you mentioned the word feedlots, and that pushed a red button.
Good.
and probably we're on the same side of the issue. But I think there is something that just doesn't make sense at all, except economic sense. Is to turn a ruminant that is programmed to use grass into a monogastric by feeding them corn, soybeans, and God knows what else, just so we can put much more fat in our meat, more cholesterol in the parts of the red meat, so we eat it. It's delicious steaks full of fat and so on. We get more cholesterol in our veins and heart attacks and so on. The whole thing is a real stupid, vicious cycle. Now, it happens to be very profitable. That's a problem with it. But if there's one thing I would like to see some change in the whole chain, probably has very little to do with climate change, but it has to do a lot with our health, is why don't we just let the ruminants be ruminants and not do this feedlots that cost mountains of manures and all this stuff, and bad for our health.
I'm going to let a couple of questions accumulate, but
Two seconds.
if that question's in the same general area, that would be better.
Feedlot, and I hate
No,
feedlots too, but they produce actually dramatically fewer greenhouse gas emissions per pound of beef than grass-fed beef.
Oh, that is true.
And so
that is true.
I hate feedlots too, but the reality is that the emissions.
Emissions from what? I don't understand.
Emissions from methane.
From what?
From manure.
So the emissions from a cow are dependent above all on two things. One is how long does the cow have to be alive before you slaughter it and wait? And the second is the energy and protein content of the feed. The lower the energy content of the feed, the more methane you produce. So it's a horrible thing, but it is actually
been shown by virtually all analyses that feedlots unfortunately produce dramatically fewer emissions per pound of beef.
And they would produce fewer still if they were priced on carbon because they would gather some of the methane. Other questions in this general area? Was your question in that area?
Degradation of soils in Africa? Does that count?
Let's see if we got some. Let's see if we have some questions that are closer to the first to Pedro's topic. First, any others? Yeah.
I just have a quick.
Loud, please.
Quick follow-up. We're talking about for example, the feedlots have less, relatively less greenhouse gases per emission per meat production. But it's efficient in terms of per unit meat production. But there's also a effect in the economy, economics, like the rebound effect, which suggests that even though we're probably gonna have a more efficient technologies, however, it might drive up the consumptions of that products, and then if there's no governance or regulation in place, then it might possibly lead to more of consumptions and also the productions in that even though efficient systems, and then it might resulting of more emissions.
Okay. Yes, behind you. Yes.
Yeah. Another consideration following up on these is you're not looking at how the grass is managed in order to have the livestock on grass. When you look at how the grass is managed and you start rebuilding the organic matter in the soil on a managed grazing system, then you're sequestering carbon there that doesn't get counted in these budgeting processes that you're talking about here.
Okay, others on this topic? Okay, so these are two very, I tried to be provocative, I succeeded on this too. The residues issue, you just have an obligation to close the loop with the climate community on biofuels. If residues cannot be used without limiting the sustainability of the productivity of the land, and that's just an across-the-board statement, doesn't have to be qualified at all, may get that across. If you have to qualify, one of the strategies would be, for example, to burn biofuel, but try to capture the residues, which residues, nutrients, which particular elements would you like to get back in particular. It gets more interesting, but biofuels are so central to the discussion of climate change in the IPCC, and your inputs are not there if you're telling me that residues are off the table because they play such a prominent role, even in the most recent report. So please close the loop. It's one of many loops where we have silos in universities. It's a really important one. The second one about feedlots, again, you said this doesn't make any sense except economically.
And environmentally not.
No, it doesn't make any sense except it doesn't. Well,
they're horrible ironies in the.
I can report a conversation with a man who had a large amount of other people's money to spend to develop biofuels in Brazil. And after spending a reconnaissance for a couple of months with other people working for him, he said, we just got to bring American animal husbandry to Brazil and we'll have lots of land to plant biofuels on. So there is a connection, and I think there are many people for whom the animal welfare is way up there as one of the issues. We're not ready to trade. The health issues, maybe. So again, it's real. It's a real intersection of the two subjects. But what about statements that it doesn't make sense except economically? You three economists going to take that?
That's what you mean. I'm not an expert in that area.
Well, do you know other areas where it doesn't make sense except economically?
Economically, it's just a matter of economies of scale, right? And economies of size. But in terms of the biofuels debate,
I meant simply the things that make sense economically have a hard time not happening unless you're very vigilant. That's all I'm trying to say. Okay, so you wanted to bring the subject to a different direction, sir?
Yes, but I'll finish up on residues, and that is...
Please do, but loud, please.
I've been involved in residue-related work since the mid-1980s, and there are agronomists all over the country that have done superb work on this, and it's in the literature, and it's been there since the 1980s.
No doubt it.
So it's there.
But it doesn't get carried to these other people.
Yeah. So that's the agricultural silo problem.
Yeah.
The problem is you energy guys, you don't know anything about our subject, right?
No, I think
So
it's-
you're doing the right thing. Coming to the conference.
I personally don't work on biofuels at all, but I had one person who was here in our PIIRS program, Felix Kreutzig, who works in Berlin, had a major role in the biofuels chapter of IPCC, and he described basically war among the various interest groups and points of view in that subject. It is probably the most contentious piece of the climate agenda right now. So it needs all the help you guys can get.
And if I could just point out that
You agree about that?
The language on BECS.
He hasn't finished yet.
I'm sorry.
We'll finish that now. We'll get back to it.
Well, just saying, the language on BECS was even written not by Felix's group. So that there were 3 different sections dealing with bioenergy, and they are written by different people and no particular relation.
So that is the overlap subject for the moment. Okay, now what was the rest of your, what was your question, sir? Could you identify yourself again?
Yes, Otto Doring, Purdue University. As a good ender for the afternoon, let's talk about the depressing thing that Cheryl presented in terms of Africa being in a position where the natural resource, in essence, base, a lot of that has been eroded. And my question really is, what are the trade-offs we face today in terms of our ability to try to renew these lands or not? Particularly if you figure in climate change with more irregular rainfall, with higher temperatures, and if part of what you have to do is increase the carbon content of these soils and deal with the nitrogen-carbon ratio, which at high temperatures is not that easy. I guess part of the reason I ask this is my major experience with this is the British groundnut scheme right after the Second World War, where they brought in used tanks finally to try to plow the hard pan soil, and the tanks couldn't do it.
Other questions, comments from the audience? Seeing as already asked one, somebody who hasn't. Yes, go ahead.
Mark Levy, Columbia. It's just an observation triggered by the biofuel discussion. That if the main problem that we're wrestling with is these risks that cascade across systems in complex ways, I think we have to recognize that that managing these things is going to take the invention of new tools. Because this is a clear illustration of not being able to make use of the tools that we normally use to manage these kinds of things. We can't use the market to send the right signals to direct investments in the appropriate way. The market's not doing that. We can't even use our kind of scientific methods because they're getting disparate answers and we're not agreeing on what the implications are. So, I think that one thing I draw from this is that if you're setting a high level of ambition, you want to help the world manage, at least 5 or 6 big global systems that are interacting. It's even bigger than those 4 because you don't have energy up there. Then, we're talking about inventing new forms of discussion, dialogue, and governance. Perhaps as transformative as the invention of the modern science establishment in the 1800s or something like that.
Yes.
Yeah, John Wargo. I'm fascinated by your challenge to think 50 years down the road about the carbon tax and what its influence might be on food. And I'm wondering, since we have a number of economists here, what do you think would happen to international beef and dairy and perhaps fish markets, which are carbon-intense types of food? What would happen to those markets if we adopted a $100 per ton carbon tax?
If I could cross your comment, I didn't say in 50 years, and I don't think that's the right time concept. I think if we're going to attack climate change with anything like the seriousness of even the European decisions of the Parliament yesterday, it would be 15 years to see a price like that.
15 years
comment
is
on that,
Windows
specifically. I think that, yes, tax pricing, get the price right. But that price should not only affect economic efficiency, but also the so-called externalities of the environment and health costs. When you eat lots of beef, actually it could lead to lots of NCDs. And that would be non-communicable diseases. Okay.
Yeah, I was
that
thinking-
has social.
What's NCDs?
Non-communicable diseases.
Great. So, yes, it will affect the market, but you needed to fix a market. Because right now the market does not deliver good nutrition, does not deliver good environment, does not deliver to cut the carbon emissions.
I'm glad Calum put in a time so I could correct it. In fact, think 10 years, ramping up $10 a ton of CO2 per year for 10 years, and just double that number to be tons of biomass, dollars per ton of biomass, up to $220 steps. And assume that it's believed by industry and by agricultural capitalism. The investments are going to be there that are appropriate to, because it's not only is it proposed, but it's somehow convincing. That's always the hard step. But assume it's convincing and figure out how the system responds. Then
I wanted to add to Otto's comment, could we perhaps look at reducing risk through perennial agriculture? So much of our agricultural systems are based on replanting each year, and the reason we need insurance is if it fails. Where does perennial agriculture fit into a less risky agricultural model?
Yes. Yes.
So I do think there is a common thread, and it is carbon. And so I think it gets to Otto's question. So just on your temperature issue in the tropics, the temperature issue on decomposition carbon nitrogen, to me, not currently the big issue, perhaps in the temperate zone, but in the tropics I don't have to worry about it. But it is increasing the biomass. It is increasing biomass, whether it be, well, biomass and soil carbon. And so that, to me, is you need the biomass to get soil carbon stocks back up. And currently, there are all sorts of limitations to people increasing that biomass production. Crops, okay? Not getting enough nutrients back into it, not getting enough labor, utilities, whatever. There are constraints. There's real bright sides too, but people need to know the challenges to that. So one, we can't get enough biomass in these systems to get the carbon there. A lot of people say, oh, so let's do clean development mechanism, carbon offset projects with smallholder farmers. Well, the prices of carbon, they wouldn't care, and they don't. It's just too low to make.
But much lower than would be to deal with climate change seriously. It might be possible.
No, so that's what I love to hear, this $100 a ton. That actually might then start getting some of these incentive mechanisms, so there is this increase in productivity, increase in ecosystem services, and some carbon stored in these lands that currently cannot.
One of the projects mentioned today was where they work to pay for the insurance in the communities. They have a discussion about how do they increase their resiliency, increase their productivity, and in many of the communities they choose what that work will be as a community based on discussions that are informed by global processes. And in many of the communities they choose reforestation. And so I think what's really important is picking up on this governance issue is it's not deciding in Geneva or New York what the rest of the world should do, but having a governance system that's not, invisible hands letting everyone decentralize do everything, but a government system that spans so that from the villages people are making decisions and have the tools to make those decisions and the barriers to do the things that make sense are addressed, all the way to the global processes. That's the challenge that we face. And it's like you said, it's a challenge like the rise of a science-based governance.
You have a comment for the okay. I want to force, are there a couple more questions? We are allowed this.
Oh.
Two in the back, okay. Go ahead.
Thinking about tools that can help improve resilience, I wonder if the panel has any thoughts about the use of seasonal climate forecasts for improving resilience, reducing risk, and it was mentioned a little bit there, I think, by someone on the panel about using temperature forecasts or whatever. Given that they're, inherently uncertain, and what's produced now over Africa, especially, is very non-local, so essentially useless in some respects. So, can you tell me about how it's used at the moment and what the prospects are in the future for using it to reduce risk?
I think I'm contractually obligated to answer that question because I work at a place that was based on seasonal forecasts, IRI, and we had a big event a couple days ago about that. So, yes. Just trying to keep people attention. Seasonal forecasts, in terms of the insurance, play a big role. And it's this question of, it impacts the price of the insurance. And the insurance is about the probabilities, what's going to happen, and the opportunities you have. So if and insurance is something, if the seasonal forecast can forecast 50% of the R squared, then the insurance can cover the other 50% if it's correctly designed. And so you want to be getting the fertilizer to the places where it's likely to be working that year, and have people be more conservative where it's not likely to be working. And whether it's that year or that decade or in terms of a trend, you want to be trying to provide a system that makes it possible to do the things that make the most sense. But it's incredibly complicated, and it's something that's talked about in these insurance products, but hasn't been addressed explicitly, although the reinsurance companies price it in.
You want to find maybe the final question?
Okay, yeah, it's just a question for Luke, and it goes to the issue of the trade restrictions. And I guess my question is, how should we look at the prospects of preventing trade restrictions? Do we say that there's a real possibility that the World Trade Organization and other international organizations can be effective in preventing that, or do we have to basically accept the situation that countries will impose trade restrictions and then design our system such that we're a bit more robust, given that that's what's going to happen?
I think it's the former. I think my reading of the situation when I talk to colleagues is it's not on the agenda of the WTO, and they can't get it on the agenda of the WTO. Exporters are not ready to accept it. But in many ways, I'm fully in agreement with you. Trade is a mutual obligation. This is, and especially in markets where you can really lock out, it's not going to happen every year. It happens every 30 years maybe. But it's clearly the exporters want the markets to be open, but they don't want to take on the obligation that they will export also when things are getting tight. And that seems to be the situation politically. It doesn't seem so. Yes, we need to work with other solutions. I think clearly the idea in the last crisis, the 2007-2008, there was an element of information as well. There was a perception of big rice shortage, which led to a lot of hoarding and which added to the price spike. But in reality, there wasn't a real shortage of rice, which was different from the crisis in the 70s. So I think there has been a lot of progress on getting more information out there. China at the time was not willing to release information about its stocks, for example. Everybody was guessing. I think they have come to the table and be part of that information sharing. So there has been a lot of progress. I don't think there has been a lot of progress on sort of the buffer stock issue in the sense of that's considered too costly and too difficult to manage, although there may be a bit at the regional level. And I think sort of in addition to the information, the other final element in preparing that sort of the idea is absorb the price shock and put in place social safety nets so that the poorest are protected from the price shock. So that's sort of, I think, where the debate stands.
And the safety nets would be at the national level? Is that
organized, at the national level.
Okay, I think we should call this, we've split the difference between 4:45 and a 5 o'clock ending. Those of you who are not from Princeton, I hope you'll enjoy the walk around the campus. It's a beautiful campus, as many of you know. And if you want to help, ask some of us who are at home base. Let's thank ourselves.